Hello and welcome to this week's Crypto Roundup. This week we wish a happy birthday to the Bitcoin white paper, with Bitcoin's continued rally and BlackRock attracting top market makers to its potential ETF. Plus, the UK stepped closer to crypto regulations, US regulators fought over a potential rule, and much more. I'm Michael Del Castillo, a Knight Bagehot Fellow at Columbia University, and this is your weekly crypto recap. This week marked the 15th anniversary of the publication of Satoshi Nakamoto's Bitcoin white paper, and for fans of Bitcoin, there was an extra reason to celebrate. Following on the number of promising developments regarding what is increasingly feeling like the imminent approval of a Bitcoin ETF, the Federal Reserve left interest rates unchanged, fueling investors' risk appetite. On Thursday, the price of Bitcoin jumped 16% over the past 10 days, doubling what it was a year ago and reaching a peak of $35,300. In fact, each of the top 10 cryptocurrencies by market cap followed Bitcoin up, that is, except for Dogecoin. One of the most likely contributing factors to Bitcoin's rise is global asset manager BlackRock, widely seen as a leading candidate to receive approval for the first spot Bitcoin ETF in the United States, which would make it easier for institutional investors to gain exposure to securities tied directly to the price of Bitcoin. To give an idea of what impact such an approval might eventually have, a recent false report suggesting that BlackRock had already secured the permission was enough to trigger a 10% rally in Bitcoin's price before it retreated to pre-report numbers. Adding to the intrigue was a CoinDesk report that market-making giants Jane Street, Virtue Financial, Jump Trading, and Hudson River Trading have engaged in discussions with BlackRock about potentially providing liquidity for the ETF. Though unconfirmed, financial advisor Bernstein predicted that Bitcoin could reach $150,000 by 2025 if those reports ended up being true, and if the SEC approved a Bitcoin ETF early next year. In the analyst note, Bernstein estimated that as much as 10% of Bitcoin's circulating supply could shift into the exchange-traded funds. But as we all know, crypto analysts have a long history of being hilariously wrong, so we'll hold out our enthusiasm on that for now. On Monday, the UK government unveiled its latest proposals for cryptocurrency regulations, which are expected to be implemented slowly over the next year. Additional controls on stablecoins, backed by more stable assets like the US dollar and euro, are set to be introduced early next year, followed by so-called algorithmic stablecoins that maintain their price thanks to automated algorithms that control supply and other factors. According to the government update, these regulations will place such activities under the oversight of the Financial Conduct Authority, or FCA, and align with the government's previously announced goal of making the UK a cryptocurrency hub. Treasury Minister Andrew Griffin described his optimism about the changes on social media, emphasized that the regulator aims to position the UK as an attractive destination for crypto assets. This follows on an update from the FCA earlier this month that included guidelines for cryptocurrency advertisers. The now clarified guidelines require firms that promote cryptocurrencies to include risk warnings to customers and provide evidence supporting their claims. In a much-needed change, the guidelines require that creators of cryptocurrencies claiming to be backed by commodities must substantiate their backing with disclosures, independent audit, and proof of deposit. The FCA also stressed that investors should do their own due diligence on the creators of the assets and the services they offer to protect themselves from fraudsters. The financial watchdog warned approved companies not to use their green light status to gain competitive advantages. Already, the newly registered UK subsidiary of payments giant PayPal is facing a number of restrictions. While existing customers can hold or sell previously approved assets, PayPal and others must receive separate permission from the FCA to onboard new clients in the UK or let existing clients transact in new assets. On Halloween, a little-known but influential organization within the U.S. Congress, known as the Government Accountability Office, criticized the SEC for mishandling its contentious crypto accounting guidance. Issued in 2022, the so-called SAB 121 requires that financial firms holding customers' crypto assets record them on their balance sheets as a liability, which requires a balancing asset. Since banks' business model largely relies on lending out their users' assets, Republican politicians and crypto advocates have argued that the rule could prevent SEC-regulated banks from offering crypto custody services. The Government Accountability Office argued that the SEC should have sent the Staff Accounting Bulletin to Congress as an official rule rather than treating it as formal guidance. The GAO's claim didn't immediately change the status of SAB 121, but suggested Congress should take a closer look. There's now a December 31 deadline for lawmakers to decide whether they want to pass a resolution or invalidate the rule. Also on Halloween, the Commodity Futures Trading Commission released a statement saying it had paid out $16 million to whistleblowers this year, most of which implicated cryptocurrency companies. Tether, the issuer of the $84 billion USDT stablecoin, released its third quarter attestation claiming $3.2 billion in excess reserves, slightly down from the previous quarter's $3.3 billion. To be clear, this is not a full audit. Rather, BDO Italia, an independent subsidiary of BDO, is the latest of a revolving door of firms claiming Tether had funds on just one particular day, in this case, September 30th, 2023. It says nothing about what was there the day before or the day after. The report highlighted what it describes as the highest ever percentage of cash and cash equivalents, primarily consisting of U.S. Treasury bills or T-bills, believed to be among the most stable assets and used to help maintain the stablecoin's peg to the U.S. dollar. Similar to the so-called risk-free long-term U.S. Treasury bonds that contributed to the collapse of the Silicon Valley Bank, T-bills mature over a much shorter time, making them more liquid and easier to sell in a pinch. This is crucial if you're looking to get out of sticky situations. The report also indicated that T-bills accounted for $72.6 billion of Tether's reserves. While the assets may prove more stable than those previously backing the stablecoin, multiple reports this month have shown concern over U.S. Treasury Department plans to flood the market with $700 billion worth of new bills next year. Separately, the attestation claims that Tether has $2 billion in secured loans in its reserves. That's in spite of last year claiming that it would eliminate those loans this year. That got pushed over, again, it turns out, to next year, so we'll have to wait and see if or when those loans ever go away. 3 months ago, a little-known self-regulatory body called the National Futures Association gave Coinbase the right to officially launch crypto futures trading. Of note, the F in FTX stands for futures, and Binance and BitMEX both rose to global power trading the assets with uncertain or non-existent regulatory permission. Coinbase is now also in the same business with regulatory permission. It's much-needed good news for the struggling giant, which has lost 3/4 of its market cap since going public in 2021, and which is now in a heated legal battle with the SEC, which claims the exchange is operating an unlicensed securities exchange. The futures contracts include options for so-called nano-sized exposure to Bitcoin and Ether, representing 1/100th of a Bitcoin and 1/10th of an Ether, respectively, which could make the assets more affordable to a wider range of retail investors. As the bear market continues to constrain investors in the crypto industry, Hong Kong-based blockchain gaming company Animoca Brands managed to secure a $50 million investment through a partnership with Neom Investment Fund, the investment arm of the region in northwest Saudi Arabia dedicated to technology and innovation. This collaboration will focus on Web3 initiatives and the development of Web3 enterprise service capabilities to support technological advancements in Riyadh and the Neom region. Neom coming from a portmanteau of the Greek word for new and the Arabic word for future, according to its website. Additionally, Animoca and Neom will establish a hub in the region to foster local Web3 projects. And that's all. Thanks so much for joining us today. Looking forward to chatting with you next week. Unchained is produced by Laura Shin with help from Kevin Fuchs, Matt Pilchard, Juan Aronovich, Megan Gavis, Shashank, and Margaret Curia. This weekly recap was written by Brandy Betts and edited by myself, Michael Del Castillo. Thanks so much for listening. Have a good weekend.
Unchained is now a part of the CoinDesk Podcast Network. For the latest in digital assets, check out Markets Daily, 7 days a week, with new host Noel Atchison. Follow the CoinDesk Podcast Network for some of the best shows in crypto.